Hi, this is Tom from Franc. Record levels of unemployment have seen the number of Forex trading ads skyrocket. Seriously, just search investment and see how many pop up. They claim that you can make thousands of dollars a day even if you only have a modest amount of money to invest. It's all very tempting. But hang on, what exactly is Forex trading? How does it differ from trading shares or unit trusts? Well, Forex is short for foreign exchange, the act of buying and selling one currency for another. Buying dollars with rands before a trip to the States would be considered a Forex transaction. Looking globally, the Forex market value is in the trillions of dollars. Forex trading is like other sorts of trading in some ways. You buy at a price with a view to selling at a higher price. Let's say for that US trip, you went and bought dollars at 15 Rand per dollar. Then you sold the remaining dollars when you got back to South Africa for 16 Rand a dollar. That's 1 Rand profit for each dollar, or almost 7% return. Not bad. Forex traders don't trade physical currency. Rather, they buy and sell derivatives on margin. This means taking large positions against small deposits. Imagine buying a 1 million Rand house with a 100,000 Rand deposit. The bank covers the rest. Sounds good. But if the market falls and you sell for 900,000 Rand, everything goes to the bank and you lose your deposit. So a 10% drop in asset value means a 100% loss for you. That's a gearing multiple of 10. It's precisely this gearing multiple that makes Forex trading so dangerous. In the Forex market, the gearing multiple is 50, meaning that big gains can turn into catastrophic losses really, really quickly. You should also know that Forex traders are simply betting against each other on the direction in which a foreign currency will go. So it's even less predictable than a roulette wheel. But many people will say it's the same if you buy shares or a fund like Suffix 40 ETF. You only sell when you think the price is falling, and a person only buys if he thinks it's rising, right? But there's one important distinction here. When you buy shares or a fund, there's an actual asset that you own, has value, and pays dividends. In the Forex market, you own nothing. You're only placing bets. If a Forex trader goes short, betting that a currency's value will fall, then all profit is dependent on that price falling. But on the other side of the bet, the person who bets long that the currency's value will increase needs the opposite. When you sell a house, the buyer and yourself are not necessarily on the opposite sides of the trade. Forex trading is a zero-sum game and not an exchange of assets. Consider a simple property investment. Builder Bob constructs a cottage and sells it to Kate for 100,000 Rand. Bob, as a developer, makes a profit. 8 years later, Kate wants to move to a bigger house, so she sells to Mac and makes a profit of 250,000 Rand. 7 years later, Mac decides to immigrate and sells for 500,000 Rand, making a profit of 150,000 Rand. In this example, everyone is making a profit, and no one sells because they think prices are going down. Kate and Mac, not really on opposite sides, they're both long in property. In other words, they both believe housing prices will go up. But when it comes to Forex trading, a seller means that you are taking a short position against someone who thinks the price is going up. It's a brutal game. Each Rand you make is a Rand someone else has to lose. That's why it's called a a zero-sum game. The winners' takings literally are taken from the losers. Sure, some talented Forex traders can and do make a profit, but the vast majority who play this game wind up losing money or breaking even in the best scenario. So if you're thinking of Forex trading, think about this. It's a 50-50 game in which half the players have to lose. Do you think you're smarter than most people or have a better system? The few who do make a profit are extremely disciplined and highly skilled experts who follow the market every day and have an almost encyclopedic knowledge of the Forex market. Unless this sounds like you, I'd stick to investing. Investing also has an advantage. The odds are actually in your favor. Looking back in time, most people have actually got a positive return on their house purchase. Sure, there have been dips in the market, but overall, housing prices have gone up. The same is true with the equity market. Despite a few crashes here and there, I guarantee you that in 10 years' time, the all-share index will be worth more than it is today. Shares also pay dividends, and property can earn a rental income. This is real value. In a nutshell, buying quality assets puts the odds in your favor, whereas trading in Forex is like tossing a coin. Unless you are a wizard or have some secret ability that millions of expert traders don't, you're always going to have a 50% chance of losing money.